The cash surrender value, often abbreviated as CSV, is a crucial concept in certain types of life insurance policies in Canada. It essentially represents the savings component of a permanent life insurance policy that has accumulated over time and can be accessed by the policyholder. Let's break down what it is and how it works. When you pay premiums for a permanent life insurance policy, such as whole life or universal life, a portion of that premium goes towards the cost of insurance. That's the part that pays out the death benefit. However, another portion of your premium is allocated to a cash value component. This cash value grows on a tax-deferred basis over the life of the policy. The cash surrender value is the amount of this accumulated cash value that you, as the policyholder, are entitled to receive if you decide to cancel or surrender your policy before it matures or before the insured person passes away. It's important to note that the cash surrender value is typically less than the total cash value, especially in the early years of a policy, because it often has surrender charges or fees deducted. These charges are in place to help the insurance company recoup their initial expenses for setting up the policy. As the policy matures, these surrender charges usually decrease and the CSV will grow closer to the full cash value. Now, how can you benefit from the cash surrender value in the Canadian context? There are a few primary ways. Firstly, you can surrender the policy for its cash value. This means you cancel the policy entirely and receive a lump sum payment equal to the CSV. This can be beneficial if your financial needs have changed and you no longer require the insurance coverage, or if you need access to a significant amount of cash. Keep in mind, however, that surrendering the policy means you lose the death benefit coverage. Also, any gain on the policy, that is, the amount received that exceeds the premiums you've paid, may be subject to taxation. Secondly, you can take a policy loan. Instead of surrendering the policy, you can borrow money against the cash surrender value. The policy remains in force, and the death benefit is still active, although it will be reduced by the outstanding loan amount if you were to pass away before repayment. Policy loans typically have an interest rate, which you need to pay back. The advantage here is that you're borrowing from yourself, and the loan approval process is often much simpler and quicker than traditional bank loans, as your policy's cash value acts as collateral. Thirdly, you can use the cash value to pay premiums. In some cases, if you're facing financial hardship, you can instruct the insurance company to use the accumulated cash value to cover future premium payments. This can be a short-term solution to prevent your policy from lapsing. Fourthly, you can reduce the death benefit or convert to a paid-up policy. With some policies, you can use the cash surrender value to purchase a reduced amount of paid-up insurance, meaning you no longer have to pay premiums, but you still retain some level of coverage. Finally, the cash value can serve as a source of funds for retirement or other long-term goals. While the primary purpose of life insurance is protection, the cash value component of permanent policies can become a significant asset that can be accessed later in life to supplement retirement income or fund other large expenses. Now, let's move on to some key considerations when dealing with cash surrender value in Canada. The first and perhaps most important consideration is taxation. As mentioned, any gain on the cash surrender value, that is, the amount by which the CSV exceeds your adjusted cost basis, generally the total premiums paid less any dividends received, is taxable income in the year you surrender the policy. This is a crucial point to discuss with a financial advisor or tax professional to understand your specific tax implications. Policy loans generally are not considered taxable income as long as the policy remains in force. The second consideration is surrender charges. Be acutely aware of these. In the early years of a permanent policy, these charges can be substantial, significantly reducing the amount you would receive if you surrendered the policy. The longer you hold the policy, the more these charges typically diminish or disappear altogether. Thirdly, understand the impact on your death benefit. If you surrender the policy, the death benefit is gone. If you take a policy loan, the death benefit will be reduced by the outstanding loan amount, plus any accrued interest if you pass away before repaying it. This can have significant implications for your beneficiaries. Fourthly, policy type matters. The way cash surrender value accumulates and can be accessed differs between whole life and universal life policies. Whole life policies typically have a guaranteed cash value growth, while universal life policies offer more flexibility in how the cash value is invested and can therefore have more variable growth. Understanding the specifics of your policy is paramount. Fifth, alternative options. Before surrendering a policy, explore all your options. Can you reduce the death benefit? Can you make it paid up? Is a policy loan a better fit for your short-term needs? Sometimes, keeping a policy in force, even with a reduced benefit, might be more advantageous than surrendering it entirely. Lastly, and this cannot be stressed enough, seek professional advice. Life insurance policies, especially those with cash surrender values, can be complex. Consulting with a licensed insurance advisor and a tax professional is highly recommended. They can help you understand the nuances of your specific policy, assess your financial situation, and advise you on the best course of action given your individual circumstances and goals. They can also help you navigate the tax implications and ensure you make an informed decision. In summary, the cash surrender value is a valuable feature of permanent life insurance in Canada, offering flexibility and access to funds. However, it comes with important considerations regarding taxation, surrender charges, and the impact on your insurance coverage. Understanding these aspects is key to effectively utilizing this component of your life insurance policy